John, Mary, I want to say thank you and welcome back to our office today. I had so much fun chatting with you at our first appointment and learning a ton about your situation. I know it seemed like we were drilling you with questions, but it really gave us a background on what your financial situation looks like and some of your goals. So what I want to do today is to go ahead and go over our financial plan that we've created for you. One of the things you mentioned that you wanted to do was to have a full comprehensive financial plan. You also wanted to look at long-term care policies and get a recommendation on that. You wanted us to answer your questions on the taxation of the installment agreement and invest the 25% down payment. So as we go through the recommendations today, you will see all of those items addressed. A couple of other things you mentioned that were important to you. You wanted to reduce your estate and gift tax liability if you were to have any, and make sure that all of your estate planning documents were in place. You also wanted us to review your insurance contract, just making sure that you have appropriate coverage, and see if we can reduce those personal income taxes at all. So we also looked over your portfolio to see if there were any things that needed to be changed there. So if you are ready, we'll go ahead and jump into this plan. A couple of assumptions that were made, and this is written out on the first page here. A couple of assumptions that were made. We did assume the rate of inflation at 2.25%. We assumed the risk-free rate of return at 1%. We assumed the market premium risk was 7% and the standard deviation of the market was 11%. So you may not know what all those mean right off the bat, but that's okay. I just want to let you know that those were used in our calculations. So I want to start with just an overall summary of financial health. So the primary documents we used for this report were the statement of net worth, so your balance sheet, and then your cash flow analysis. So in looking at those, your financial situation, you've got a net worth of about $13,744,516, and then you've got some net disposable income of about $1,107,472,000. So between the net worth and the positive cash flow, we think you are in good shape to meet your goals. So that's a good sign there. And we also wanted to make sure that you were in good shape otherwise. So one of the things we did notice is that your current ratio is rather high. What that measures is it measures your current assets compared to your current liabilities. So assets that are easily available, so things that can be liquidated like savings accounts, CDs, anything that's very liquid cash and low risk. And we compare that to debts that are due in the next year. So primarily the little bit on the vacation home and the credit card debt. So when we did that measurement, what we saw is that you were significantly above the benchmark of 1, which is basically having enough assets to cover a year's worth of liabilities. The other recommendation that we normally make for liquid investments is to have about the equivalent of 3 to 6 months of expenses in these liquid type investments. So for you, that would be about $142,105 if we were going for that 3-month emergency fund, or $284,210 if we were going more on that 6-month side. What this tells us, you have $1 million right now in those liquid, a little over $1 million in those liquid assets right now. So we have about $755,790 in excess of our typical recommendation of 3 to 6 month emergency fund. What worries me about this is while these investments are very safe and your savings accounts and the CDs are low risk, what we do risk is inflation, right? The risk of inflation. So typically these investments do not keep up with inflation. So what I see in your cash situation is that we are exposed to too much inflation risk, and this could be remedied by going ahead and investing it in a couple of different ways. So some of the things I was thinking for that excess $755,790 that we have in cash, as well as the $1 million down payment that came in this year, is using them for some of your other goals, and also trying to be creative in how we take this out of your estate and lower our taxes. So the first recommendation I have is contributing to 529 accounts for each of the grandkids. So I know something that you said was really important to you was being able to support each of your 3 grandkids and helping them go to college. So you can so the two of you combined can do up to $34,000 per year per grandchild into a 529 plan. These funds grow tax deferred and come out tax free as long as they are used for qualified educational expenses. One rule that is related to a 529 is that you can actually do up to 5 years worth of contributions as one lump sum. It's called front loading the 529, which means that you could contribute $170,000 per grandchild or do about $510,000 total into these 529 accounts. This would get the money into a non-taxable where it gets tax deferred growth, and then like I said, it would come out tax free as long as the grandkids did use it on educational expenses. One of the downsides is if they do not use this on educational expenses and they make a non-qualified withdrawal, they would get a penalty of 10% and it would be a taxable withdrawal. Another use of the excess funds that I can see is paying off the mortgage on the vacation home. Currently, you still owe about $49,284, and it's 5% interest, which is a decent interest rate. So, one thing I can see that would be a good use of some of this excess cash we have laying around is paying off that vacation home. Lastly, since that doesn't take care of all of it, and we do also have the $1 million down payment, I would use the rest of that to help bolster your mutual fund and your stock portfolios. So these are non-qualified portfolios. We could use some of these funds to help diversify those accounts and get some more tax efficient investments in there. I'll talk about that more in just a second. All right, so in terms of your insurance coverage looked pretty good, but we did find a couple of weaknesses in your coverage. First and foremost, the homeowner's policy on your primary residence, you had too little coverage there for the face value. So typically we want to see about 80% of the current home value covered by your insurance policy. You only had about $400,000 worth of coverage, and 80% of your current home value is about $720,000. So really we're short about $320,000 of coverage. So what I would like to do is see you raise this coverage level up to that $720,000 mark. If for some reason that makes your policy a little too pricey for you, you do have a very low deductible on that policy. It's only $500. So we could possibly look at raising that up a little bit since you do have sufficient cash reserves, and that could bring down the price of the policy. The other thing I noticed, you don't have any endorsements on either home, and I see that the vacation home is really, really close to the Connecticut River and is in danger of possible flooding. So one thing a lot of people don't know is that flooding is not covered on your standard homeowner's policy. You have to get an extra endorsement for that. So I would like to see you add that flood coverage to your vacation home. Next thing we noticed in your insurance is that the property damage coverage on the auto policy was too low. So basically, if property was to get damaged in an accident, it would only cover up to $15,000, which isn't gonna be able to fix a lot, right? A lot of cars cost more than that. So I definitely recommend increasing that up to an average that reflects, to an amount that reflects the average auto value. The other things that I noticed, the boat doesn't have specific coverage. If you're out in that boat and you're running around and you hit somebody out on the water, that is not covered by your auto policy. Some people think it is, but it is not. So that may need additional coverage. And then the other thing you have is the 1918 inverted Jenny stamp. This has significant value and wouldn't be fully covered under your homeowner's policy. So you may want to consider getting a specific policy just to cover that stamp. Couple of other things when it comes to insurance. So one of the things we can do to help reduce estate taxes, as well as give to our grandchildren, is we could possibly gift John's life insurance policy over to the grandkids. So what this would look like is, we would gift the cash value of the policy today, and but when you pass away, that $2 million would go to your grandkids. So that would remove $2 million from your estate. Now, it would be subject to gift taxes of $486,000 if we did this, but we can utilize the generation skipping tax exemption, which for this year is $12,920,000. And $12,920,000. So we can utilize that. So for this specific gift, we wouldn't get up to that total yet. Lastly, the long-term care that you asked for. I think this is an important thing to consider, and I want to let you know that based on your 2023 taxable income, the maximum premium allowed for medical deduction, if we ignore any AGI limitations, for you two would be $5,960 for John and $4,770 for Mary. I think we should look into a comprehensive policy that allows each spouse to share in the other one's benefits. And I think that we should consider national averages while we're looking at these policies. So I'd like to see the policy cover at least 3 to 4 years of care. And I would like to make sure that the minimum monthly benefit is at least $5,000, if not more. If we look at the cost of medical care, for a private nursing home, it's closer to $10,000 for the coverage we would need. So we'll have to decide exactly what sort of coverage we want there and base that on your needs. Lastly, I want to make sure that whatever policy we choose has an inflation rider. Long-term care costs are skyrocketing and they are growing faster than inflation. So we want to make sure that our coverage keeps up, and we want to have a good inflation rider on whatever policy we choose. Moving on to your investments. So a couple of things on your investments is that we have non-qualified assets and they really lack diversification. Our stock portfolio is only 5 stocks. Our mutual fund portfolio is very limited as well. And when we use the Sharps ratio to analyze this, what we basically found is for the market that you are taking, so on a total risk basis, we are underperforming the market. So that is something that we'd like to fix. Another thing we found is that John's 401k, it's just got one large cap fund in it and it's 100% in stocks. John is getting very close to required minimum distribution, so we will have to start drawing on this account. So we want to bring that more conservative and also diversify it out into other asset classes besides large cap stocks. Mary's 403b is in a nice target date fund. It's performing well, so we don't think anything is needed there. So let's narrow this down to the stock portfolio. So let's start there first. So a stock portfolio, like I said, it's hyper concentrated. We only have 5 stocks. Stock A has a significant loss on it, which, if we sell that stock, we could harvest that loss and use it against any other gains we may generate by diversifying out the portfolio. When we did a CAPM analysis on this, we did found that the stock portfolio in general was underperforming the market. So what I would like to do is sell that stock A, realize the $218,000 loss, and then we can use some of the cash from the down payment and from the excess cash that you have sitting to help bolster this stock portfolio and further diversify it out. The mutual fund portfolio is also underperforming the market for the amount of risk being taken. So this was measured by the Sharps ratio. Due to your high tax bracket, we don't have very tax efficient investments in there. So one thing I saw right off the bat is that the bond fund could be switched out for a municipal bond fund, which would give you some tax benefit. So that is one thing I would like to sell. And we can offset some of that gain with the loss from stock A in the portfolio. Also, the growth fund, bond fund, and international fund have high levels of unsystematic risk. So this means risk just due to the investment, not due to the market. We like to see the level of unsystematic risk lower if we can. So I would like to also switch those out. I think we should also add to this portfolio some ETFs, which are more tax efficient, and like I said, a municipal bond fund, which is more tax efficient. So we can use, some of the proceeds if we make some of these sales. So like selling the bond fund, we can use some of the proceeds to rebalance and diversify. We can also use some of the cash and the down payment to rebalance and diversify this portfolio. John's 401k, like I said, is not well diversified. It's just one large cap fund and it is fairly aggressive. So I do want to diversify this out. Okay, so when it comes to retirement planning, so if we're looking at a couple of things for your retirement, I do think after conducting the needs analysis that your current financial position is more than sufficient to meet all of your goals in retirement. When it comes to retirement accounts, I do think we have a couple of opportunities. So John and Mary, you both still have your retirement plans and your original plans, the 401k and the 403b. I think it would be a good idea to roll these over to traditional IRAs. And the reason why is because we can do what's called a qualified charitable distribution out of a traditional IRA, or what we call a QCD. So that means when we take the funds out of the IRA after the age of 70 and 1/2, we can give them directly to charity and it does not show up on our taxable income. So John, you are currently eligible to be able to do a full qualified charitable distribution. The maximum amount you can do is $100,000. So this year, I would like to see you do that maximum qualified charitable distribution and continue that year to year. Mary, I would love to see you start those once you do reach the age of 70 and 1/2. Also, John, you had $11,000 of earned income this year. We can actually make an IRA contribution with that. Now, it won't be deductible because of your high income, but we can still get the tax deferred growth that comes with an IRA. So, John, out of that $11,000, I'd like you to do the full contribution of $7,500 for yourself. And Mary, you can do $3,500 as a spousal contribution. So then that way we can put the full $11,000 away. So you'll just have to file an extra tax form. It's the 8606 when you file taxes. When it comes to income tax planning, I'm going to repeat some of what I've said already. Basically, the investment income that you have because of your high tax bracket, it's costing you a lot. So if we can move to those more tax efficient investments, we're really going to see a reduction there. One of the things you asked about was how the installment payments are going to be treated tax-wise. So that down payment that you got this year of $1 million, out of that, $168,750 will be considered your return of basis, aka it's not taxable. The rest will be considered a realized and recognized long-term capital gain, and so that will be $831,250 on that down payment. For the first installment payment, what we're looking at is a total payment of $36,567.80. Of that, $10,000 will be considered interest, and the other $4,483 will be return of basis, and then $22,084 will be a realized and recognized capital gain. So all three of those pieces are going to be taxed different. So the interest will be taxed like ordinary income, return of basis is not taxable, and the $22,000 will be taxed as a long-term capital gain. John, one of the things you mentioned was wanting to possibly sell that inverted Jenny stamp in about 10 years. What you told me is you thought that you could sell it for about $2,550,000, and that typically, on a sale like this, you would end up paying about 15% commission. So if you were still looking at doing that, and if you are still in the highest marginal tax bracket at that time, your federal tax liability for that sale would be about $466,900. So that was one thing you wanted us to calculate as well. When it comes to estate planning, definitely some strengths and weaknesses that we're seeing. So first strength that we're seeing is that as of right now, as of this moment, neither spouse would have a taxable estate if you were to die this year. That being said, John's is very, very close to being taxable. So with the projected growth rate, it could become so. The other thing is, even though we're not triggering estate tax right at this moment, both of these estates are subject to high probate fees and expenses. So the lower that we can get that probate amount, the better. The other thing that we noticed is that there are no essential estate planning documents in place in case of incapacitation. So things like power of attorney or healthcare proxies. So that's something I think should be remedied right away. So a couple of things that we can do together or work on together is just trying to retitle some of your assets so that we reduce your probate estate and so things pass the way you want to. So I would consider retitling the CDs, the mutual fund portfolio, the vacation home, autos, and boat, as well as the inverted Jenny stamp into joint tenancy with joint tenancy in common with rights of survivorship. So this would equalize the estate a little bit as well as reduce what assets are subject to probate. So I think that would be a good first step. The other thing I would like you to do is go visit with an estate attorney to discuss other strategies for estate equalization, as well as possibly something like a bypass trust. So that's something that you do have to do with an estate attorney. So I would bring those up as well as those basic estate planning documents like the power of attorney and the healthcare proxy. So I know that was a ton of information, a full analysis on your financial picture, but I do think it's important that we go through that. And as we work together, we're gonna go through those steps in more detail. So just to summarize the most important action steps walking away from this meeting, I would say number one, we are sitting on too much cash. So too much cash and cash equivalents, so our current assets. We really only need the equivalent of 6 months expenses and savings. So we really want to use some of that extra cash as well as the down payment to do a couple of things. We want to front load the 529s. So we want to set those up and front load them. We want to pay off the vacation home, and we want to diversify the mutual fund and stock portfolios. Okay, that's first takeaway. Second takeaway, we do need to change some of your insurances. So again, the big ones I pointed out were increasing the face value of your primary residence insurance coverage. So we want to up that to $720,000. I'd like you to add a flood endorsement to the vacation home, increase the property damage coverage on your auto policy, and consider adding policies for the inverted Jenny stamp and the boat. One other thing I don't think I mentioned earlier was I'd also like you to consider getting an umbrella insurance policy. This would provide you with a little bit more liability coverage. Step 3, so third takeaway. John, I think you should gift your life insurance to your 3 grandkids to reduce estate taxes. Fourth takeaway, I'd like to see you rebalance the current stock and mutual portfolio as I described, and this could improve performance, and then we could add some more tax efficient investments. We also want to use that $1 million down payment as well as some of the excess cash to be able to rebalance this. I'd like to roll over the 401k and the 401b and do a traditional IRA so that we can utilize those qualified charitable distributions, or what we call QCDs. So basically being able to give that to charity and take it out of our taxable income. I'd like to use the $11,000, takeaway number 6, I'd like to use the $11,000 of earned income to make a non-deductible IRA contribution of $7,500 for John, and then he can make a spousal contribution of $3,500 for Mary. 7th takeaway, I'd like to set up an appointment with an estate attorney to get your essential documents in place, as well as discuss estate equalization and the possibility of a bypass trust. And then last takeaway is to consider retitling the CD, mutual fund, portfolio, vacation home, autos, boats, and inverted Jenny stamp into joint tenancy with rights of survivorship to reduce your probate assets in the estate. So with that, that is our initial summary of the steps that we think you should take to achieve your goals. And we look forward to working with you both.